Hello and welcome to a presentation on institutional audit flow integral. So today we're going to talk about the different protocols with institutional audit flow integral. What I was actually supposed to do was I was supposed to make this into one video, all right? So it was supposed to be one video for all the protocols with institutional audit flow integral, but then I decided to switch it up and make it instead a five-part video or a four-part video because there are four protocols. So rather than going for just like one lesson on all the scenarios where it can utilize institutional audit flow integral, I decided to split it into four different videos. And the reason for this is because down the line, as we go through more models, the entry or the setup or the pattern, we're going to use some of each lessons to build a model around. So that's why I decided to split it. So for future lessons, it's easier to use the lessons for like a model because we're going to develop models around, I think, around two or three of these scenarios I'll teach you shortly. So this lesson essentially is covering institutional alpha integral protocol one. So there are four protocols, and essentially the protocol is rules of engagement for entry or for utilizing the concept. So there are four protocols with institutional alpha integral, and this is the first protocol, and then there's going to be three more. So I might possibly drop them tonight or probably tomorrow, but I wanted to split it into multiple videos so that way it's easier to reference for future lessons. So the understanding before going through this content, because this is a pretty advanced content, and I'm going to upload this to the Lazarus program. So, and the Lazarus program is designed for advanced students. So if you don't understand what institutional alpha integral is right now, then you should not be watching this video. Or if you don't understand what an inefficiency is, or what a liquidity void, or a CB, or a BC, or a redelivery balance, if you don't understand what all these concepts are, then I'll suggest you go and watch the course. Watch module one of the course where I covered inefficiencies before coming back to this video or this lesson and watching this lesson on institutional alpha integral. So essentially what institutional audit flow integral is, it is a protocol or a method for getting in sync with order flow using inefficient price runs prior to a counterparty liquidity pairing. So essentially what that means is when the market is being delivered, usually the market is not delivered based off of true supply and demand. I think I posted an article on the Discord a few weeks ago, and the article was exposing how a lot of orders are going into what we call ghost feed, and they're not actually being imputed into the marketplace. So orders which are being placed by participants are not actually reflecting in price because they can bypass those orders, and it was really a crooked system. But it still is technically legal to operate that way. I think I'll probably link the article again on the Discord. But essentially, the market is not moving based off of what you think is supply and demand. The market moves based off of the next liquidity draw. That's where the market moves. So once there is a level of transaction price, then the algo starts to reprice the next level for counterparty liquidity. That's typically the way the market goes. And because the algo reprices the market to a level of liquidity and it's not being driven by real supply and demand, what you're going to see in prices, you're going to see inefficient deliveries a lot of times. So the market will deliver inefficiently, and that will be evident by the presence of liquidity voids. And it could be a balanced price range, it could be a fair value gap, it could be a BC or a CB, or it could be a redelivery balance. Any of the form of inefficiencies, it could be one of those. And what we want to do as traders, or what a lot of traders are not aware of this kind of inefficiency in price. Everyone understands the classic market gap, but outside the classic market gap, you're not really familiar with utilizing one-sided delivery for targeting liquidity pools or for entry to then target liquidity pools. Again, all of the protocols stem from having a very clear understanding of directional premise and a drawn liquidity. And without these, which is the fundamental part of this, okay, again, when I'm teaching concepts like this, they are absolutely useless if you don't have an understanding of your direction premise and your target objective. Okay, that's what gives credence to concepts like these. So again, you need those tools of your drawn liquidity and obviously your direction premise for this to be utilized efficiently for not only this lesson but the subsequent 5 or 6 lessons are going to follow this video. So as price delivers algorithmically from a base of liquidity. So a base of liquidity essentially is a range in which transactions occur in price. We don't know what kind of transactions are occurring because we don't have access to that kind of information. So we're not privy to the information of who is transacting at a certain level or what kind of orders are coming in price. But we can know just by the nature of price delivery if there's a transaction in the marketplace. And usually that would happen inside ranges. Again, that's why I see the market goes from range to expansion to range to expansion. So when a market is delivering from a base of liquidity, which is what we'll call a range, usually it's going to do so very inefficiently. And the market would want to seek the next level or the next layer of counterparty liquidity. And the reason for this is because for you to find an exit, you need someone to pair or take the opposing end of your execution or your order. So a counterparty liquidity essentially is the means via which previous transactions can be concluded or closed. So what I mean by previous transactions is if we're a buyer down here, then we need someone else to come and take our orders from us up here. And who's going to be the ones wanting to take our orders from us? Those want to buy up here. So there's going to be willing buyers at this level here. And if the market can get up there, then we can sell our buy positions to these buyers who want to buy up here. And that's how you get counterparty liquidity. So that's like layman terms of what a counterparty liquidity is. Now, when we talk about counterparty liquidity, I'm not talking about individuals like you and I wanting to be buys up here. I mean, from a fund perspective, okay, a lot of funds are trend following, and usually in a bullish market, there will always be willing buyers above a short-term high. In a bearish market, there will always be willing sellers below a short-term low. Okay, that's how it goes. And that's how you get your buy side liquidity pool and you also get your sell side liquidity pool. Now, what we're looking for is we're looking to get in sync with order flow prior to the counterparty liquidity objective. Okay, once we get up into counterparty liquidity objective, then essentially the point of utilizing our entry protocol is null because what we're trying to do is we're trying to ride order flow or price delivery. And you can see in the name, institutional order flow entry drill. So we want to ride order flow prior to counterparty pairing of liquidity. Okay, and that's where institutional order flow entry drill comes into play. So we can capitalize on one-sided price deliveries with institutional order flow entry drill. And usually in the concept or where this stems from is interbank accumulation. So around these inefficient delivery points, the algo will reprice partially to allow for interbank traders to get in sync with price delivery and then run for the next layer of liquidity. And I'm going to show you some examples and also multiple examples in like 3 or 4 or 5 videos down the line when we talk about more protocols. And what you can see here is this is institutional entry drill for protocol 1. And for each of the protocols, there's going to be the very specific scenario at which we utilize this concept. So for institutional order flow entry drill protocol 1, so whenever you see me talk about this institutional order flow entry drill protocol 1 in a live session, just know I'm referring to this exactly. Okay, so for institutional order flow entry drill protocol 1, you can see that the scenario is immediately after stop on and prior to opposing liquidity being tagged. So once we see a turtle sell or buy, we don't care. Again, it's going to be in alignment with our high time frame direction premise. So for this example I used here, I used for an high time frame bearish direction premise. Okay, so again, remember in an hour time frame bearish direction patterns on the lower time frame, if we see a run above a short-term high, that is not a very good structure. Instead, that is a run on stops to then continue to run lower. And that's the example we're using here. So after we have a run on a short-term high, where it's going to be buy subs rested, once we see that displacement that creates an inefficiency, we want to sell the discount low of the inefficiency and put our stops above the most recent high, short-term high, and we're aiming for the counterparty sell side liquidity. And you just invert this concept for the buy side. If you're looking to be a buyer, you want to buy the premium high of that inefficiency, and then your stop goes above or below the most recent low. And then for sells, this again after a stop run, which is a scenario, immediately after a stop run, the scenario, and prior to the sell side being taken out. If the sell side is taken out, we're not really interested in using this protocol because the scenario is already disqualified. Okay, so again, we need two conditions for this scenario to be qualified for our protocol one. We need a run on opposing liquidity, and then we need the market to not have expanded for the liquidity in direction of order flow. And what we do is want to short the discount low or the fair value gap in a bearish anticipation, and we want to buy the premium high of that fair value gap in a bullish anticipation. And the event here is that after the stop run, price will see the most aggressive run for the next layer of liquidity. And usually this volatility will result in an inefficient delivery profile as price runs towards the next level of liquidity. The goal is to capitalize on these inefficiencies prior to the parent or counterparty liquidity, which is what we're doing here. Because what you get usually as it tip off is the creation of inefficiencies. When you start to see the market create one-sided delivery in line with your sentiment, that means you have a very strong sentiment. The market is rushing to reach for the next level of counterparty liquidity. And our goal is to capitalize on that quickness and price when to get into that next layer of counterparty liquidity by utilizing interbank accumulation levels, which is going to be in the form of inefficiencies or fair value gaps. And that's what you have right here. So we can go look at a live action example, and one of that would be euro dollar from this week Monday. So what you can see in euro from this week Monday is on Monday we saw a run higher for buy side liquidity, and that would be the highs from Asian session. So this is, if we use the rejection block here, that's the high from Asia. Okay, so Asian session starts Asia starts here and then ends here. So this is the start of Asian session, this is the end of Asian session, and then this is let's look for New York session, and then the end of New York session. So during the New York session, what we see prior to that is we see the market run sell stops to your London session. So we have a run on sell stops, okay? Market runs below a sell side, and what we're looking for is that run lower confirmed with a run higher on dollar? That's what we're looking for. Can we confirm that swing with SMT? Dollar runs lower, or sorry, dollar runs higher, euro runs lower, so there's no SMT there. Can we confirm that with British pound cable? Euro runs lower, cable runs higher. So we have SMT here confirming that the run on euro is a stop run. It's not a run truly in direction of order flow. Instead, it is a stop run. Now, why would this not be run in direction of order flow? First of all, what's your sentiment? The sentiment is bearish. Our sentiment this week in Europe has been bearish. But again, like I warned you, the conditions for a bearish delivery is low probability because it is a Monday with no economic release. Okay, so usually what Monday does is the Monday usually will typically either range or it will run against the intended direction for the week. And that's why Monday a lot of times will create the jitter swing for that week. Okay, so what you can see here on Monday is we have a short-term low here. Price runs below the short-term low into this inefficiency. So if you take this is a buy-side imbalance, sell-side inefficiency. If you take the entire range of that BISA, which is buy-side imbalance, sell-side inefficiency, where you see the market actually trade down into is we trade down into the consequent encroachment of the inefficiency. So whenever we mention, or whenever I mention consequent encroachment, that simply means the 50% of any kind of inefficiency. And it could range from a volume balance to an actual gap to a CB or a BISI or a typical fair value gap or a redelivery balance. Okay, it ranges from any of those things. So whenever we talk about consequent encroachment, which I just simply mean 50% of an inefficiency. So what you see here is this, which is euro, runs beneath sell-side liquidity down into the consequent encroachment of this inefficiency, and then we start to see displacement. Now we have a target on liquidity, and you can see here we have very clean eyes up here. Look at this, and then this. Okay, those are very clean eyes in price. So that's something we can aim for as a general liquidity, where we can expect individuals want to be long in price. After they see this run higher, they're going to go in and want to buy the breakout. So we're at the target on liquidity, which is this eye here, because it is so clean for us. Now what you can see here during the New York session is after we run sell-side liquidity, the anticipation is we want to see the market start to aggressively price in the next level of liquidity, which is going to be on the buy side, because this run lower on euro was not being confirmed with the run lower on a correlated asset, which is the British pound, which is cable. And we also understand the time of the week, which is Monday, with no economic focus, and we understand that the market or an asset can trade against higher time frame order flow Monday to create the jitter swing for the week. So what you see here is you see displacement, small little fair value gap here, and again, like the model indicates, you want to sell the discount low in the bearish order flow. You want to buy the premium high in a bullish order flow. So if we go and look at our asset, which is euro-dollar, you can see this is the premium high of the fair value gap, and this is the discount low of the fair value gap here. So we buy the premium high of that inefficiency versus 2 for buys and sells. These guys switched up the tools or the toolbar, and it's so confusing. I don't know why this is switched up. So confusing to find certain tools. Yeah, so what we want to do is we want to put our stop below the most recent swing, and that's going to be this one here. And then we can aim for the target objective liquidity, which is up here. Again, in a bullish market, we want to buy the premium high of that inefficiency or fair value gap, and in a bearish market, we want to sell the discount low with stops above the most recent high prior to the run and stop, or after the run and stop, which is this one here. And you can see how we get up into the objective. Smooth, easy run, and the reason for this very fast response in price is because of the run and stop. Again, I've said this before, whenever you see a run on opposing liquidity, that's where you get the fastest delivery in price. The market would quickly want to reach for the next layer of liquidity because we have trapped liquidity here, trapped liquidity on the sell side down here. So if we can run for the next layer of liquidity, anyone who was selling down here, they're trapped. They're definitely getting stopped out. And the same concept you can see in action for the next day on euro, and this time we're going to look at price from a 30-minute time frame. And what you can see here on euro, I actually talked about this on the live session, this sell. So what you can see here is we have a run on buy side liquidity during London session, right around London open. We see a very sudden run for liquidity, and then an aggressive repricing lower. Again, I've taught you whenever I see runs a stop, the market will show very strong willingness want to leave that trap liquidity. So we have trap buys up here, and it will make sense for us to go beneath the sell side here and the sell side here, because these are very clean lows. You can see two lows, very clean. That's sell side liquidity. So we can aim for that sell side liquidity in price. Now what you get here is you get run a stop, displacement, and as the protocol says, you want to short the discount low in an anticipated bearish market. You can go and short the discount low here, and your stop goes above the most recent high in price. Now in this example, there is a way to refine this, and we're going to talk about this on institutional financial protocol 2. So this specific example is actually a blend of 3 different protocols, and you'll get that sometimes. Again, when I teach the protocols, there are specific scenarios for those protocols. But now sometimes you're going to get overlapping scenarios on one, and you can use, because they'll all match up in terms of how you execute them and how you place your stops in them. So they'll align, and you can use, like if you see multiple protocols for one trade, then obviously you can just apply them for your execution. Because what we have here is we have a confluence of a sell-side balance price and efficiency, which is one of the scenarios we use for institutional alpha intro, and then we also have a balance pricing here. If you cannot see the balance pricing, if you look to your left, you can see we have a fair value gap here, and if you extend that out, you can see it is very rebalanced on the sell side. So that's a balance price range. So we have a confluence of a balance price range, a CB, and then this stop run, and then the market sells off, obviously. So I don't want to use many examples because I want to give you guys a chance to go and find this on your chart. Find a lower time frame objective, identify a stop run price, and then identify the creation of an inefficiency immediately after the stop run and prior to price running out the opposing liquidity, and you see how often this plays out in price, how the market just trades into the inefficiency and will deliver from there. So you can even see one here, same thing. We have a short term high, this candle trades above the short term high, this place is lower, inefficiency, look at that, and sells off. Same thing here. After the run on this short term high, displaces, then runs for sell side, runs for buys of liquidity, inefficiency, displacement, which is what we're looking for. The displacement is a confirmation of order flow. All right. So when we see displacement like this with inefficient delivery, that is confirming order flow. Sell short inside bearish delivering price, and the market just runs lower. All right, so I don't want to do a lot of examples. This is pretty much easy to pull up and identify. And what I'll do is I'll do the second protocol for protocol. There's actually 6. I just realized there's not actually 4. It is 6. So we're gonna have 4 more videos. Now imagine I was doing 6 lessons for one video. That's gonna be like a 2-hour lesson, and I don't want it to be a 2-hour lesson because of what I explained at the start of the video. So you're gonna get video, I think around 2 or 3 protocols, if not all the remaining protocols by tomorrow, but you're gonna get them. I have to split them out so it does not take time. All right, you guys will have an awesome evening, and I'll talk to you in the live session tomorrow. Trade safe.